Assalamualaikum viewers, welcome to our channel Practical Study Planet. Please subscribe our channel if you yet not subscribed it and press bell icon for further updates. Accounting Lecture 4, Accounting for Bills of Exchange. In this chapter we will learn about why bills of exchange. What is bills of exchange? Basic terms in bill of exchange study and types of bills of exchange. Accounting treatment for bills of exchange. We'll see one by one. Why bills of exchange? In every business, funds are mandatory to keep products, services in circulation of business. Either huge or small businesses both face the funds issues. That's why a method adopted for future payments with a guarantee having different options as per needs of the situation. It resolves the shortage of funds for a particular period for meeting fund issues. What is bills of exchange? It is defined as an unconditional order in writing, addressed by one person to another, signed by the person giving it, requiring the person to whom it is addressed to pay on demand or at a fixed or determinable future time as a sum certain in money to or to the order of a specified person or to the bearer. So technically it is sound and comprehensive. We'll study by dividing into parts to make easy for understanding. Breakup of definition. It will be in writing. It will be issued from one person on the name of other person. It will be worth mentioning on it. Main amount will be mentioned. How much value for that one. It will be valid for a period mentioned on it. There will be one period when it will be due to pay. Basic terms and bills of exchange study. The drawer, dry, bills receivable, bills payable, demand bills of exchange, terms bills of exchange. Trade bills, accommodation bills, inland bills, foreign bills, acceptance of bills, discounting of a bill of exchange, endorsement of a bill, endorser, endorsee, contingent liability, bill sent to the bank for collection, dishonor of a bill of exchange. Noting charges, renewal of a bill, retiring bill under rebate, accommodation bills, effect of insolvency on bills of exchange, promissory note. These are the terms we will study one by one with the easy understanding. Drawer. The person who is issuing or drawing a bill of exchange is called the drawer of the issued bill of exchange, who will receive money in future against the issued bill. Dry. The person on whose name bill of exchange has been drawn, who will pay money in future against the bill of exchange accepted at maturity time mentioned on bill. Bill receivable. All the bills of exchange drawn for future money collection will be receivable of the company. So it will be mentioned in books of accounts as a bill receivable under current asset in balance sheet. Bills payable. All the bills of exchange accepted for future money payments will be payables of the company. So it will be mentioned in books of account as a bills payable under current liability in balance sheet. These terms are elaborated here to understanding how the accounting treatment will be at the end. So that's why be careful while study of the terms. It will be effective in practicing the accounting treatments. Demand bills of exchange. This kind of bill has no maturity date and presentable for payment collection at any time by the bill holder. Terms bill of exchange. Whereas the bill has a fixed maturity date to present for payment. These are under the categories of the types of the bills. Trade bills. This kind of bill has been drawn against trading transactions by the seller, creditor to the buyer, debtor. Accommodation bills. These bills are drawn just for help of both parties having no trade transactions with a view to get funds against these bills as per available methods of converting bills into the liquid funds. Inland bills. The bill drawn and accepted within the country that is called inland bill. Foreign bills. The bill drawn in one country and accepted across the border is called foreign bill. These are also under the types of the bills. Acceptance of bills. The process of accepting a bill is called acceptance of a bill. When drawer draws a bill of exchange, he normally sends draft to the dry. A genuine bill exchange becomes valid when it is accepted by the person upon which name it has been drawn. Otherwise, it will not come into bonding for future terms. Discounting of a bill of exchange. This is another way of treating the bill. It before maturity. The holder of a bill wants to get money. He has the option to present this bill to the bank. The bank can give immediate liquid money against this bill, but will be given the amount will be less than the mentioned amount in the bill by discounting the bill with a particular rate depending upon the bank. So thus bill is with the bank now, so bank will be the owner and holder of the bills. At maturity, bank will get money against this bill. This process is called discounting of bill of exchange. Keep in mind that bank will entertain that bills only whose acceptors are of good worth. If the drawer or holder of bill endorses to his creditor to clear the liability via this bill by signing at back of the bill, this process is called the endorsement of bill of exchange. Endorsee. The person to whom the bill is endorsed is called endorsee. The endorser, the person who endorses, is called endorser. Contingent liability. When an endorser endorsed bill to the third party against the liability to write off, but in factual its responsibility to own the bill is till its maturity and clarity, that's why will be mentioned in balance sheet as a contingent liability. In case of dishonor will be reliability in actual balance sheet. Bill sent to the bank for collection. In this case, the owner of bill sent his bill to the bank for collection from the dry and charges the nominal amount for the services. Dishonor of a bill of exchange. When the bill is not paid at the maturity date, then it is called the dishonor of a bill of exchange. Dishonor of a bill affects all the related person to whom by whom it is interacted in either way. It could be the drawer, dry, endorser, endorsee, bank, etc. Noting charges. When a bill is dishonored, the holder of the bill, drawer, banker, endorsee, or any other party, in order to make a strong ground for drawing legal proceeding against the acceptor, may get the official recognition that the bill has been dishonored. He goes to an official called notary public and gives the bill to him. The notary public will present the bill again. In case of again dishonored, it will be generated official evidence against the acceptor of the bill and to be presented in court of law for legal proceeding for payment clearance. Notary public charges some amount against each bill dishonored for proceeding legally. That charges are called noting charges. Renewal of a bill. When a bill maturity date is near and bill is near to due, but the acceptor is unable to pay the bill, then he goes to the drawer of the bill to request to cancel the old bill and draw a new bill with a new extended date. Of course, drawer will charge some extra interest amount, then will renew the bill. This process is called renewal of bill. Retiring of bill under rebate. When a bill maturity date is far, but the acceptor is willing to pay the bill before its maturity date, having sufficient funds with him, then acceptor will send proposal to the owner of the bill with some discount. If holder of the bill accept the proposal and withdraw bill before maturity date with the some discount, that process is called retirement of a bill under rebate, and the amount of discount is called the rebate special term for the bill of exchange. Accommodation bills. It could be drawn for three purposes: for the drawer only, for the dry only, for both drawer and dry. It's just drawn for the purpose of generating funds by discounting the bill from bank. Effects of insolvency on bills of exchange. Insolvency starts from the dishonoring the bill if the dry of bill is unable to pay and claims having nothing to pay. In case of insolvent of a person against bill, the irrecoverable amount will be written off as a bad debts. Promissory note. It's a financial instrument, not being a bank note or currency note, containing an unconditional undertaking signed by the maker to pay a certain amount of money only to or to the bearer of this instrument. It should be in writing, promise by the debtors, promise to pay money, unconditional. Acceptance is not mandatory, can be endorsed. That is the difference. Acceptance is not mandatory in this promissory note, whereas in bill of exchange it is mandatory to acceptance. Now we will study about the accounting treatment for bill of exchange. In one illustration in the different parts, we will explain it one by one. Mr. A sells goods to Mr. B for amounting 2000 and draws a bill for 3 months. B accepts the bill and returns to A. Case 1. Bill is honored and at maturity date. Journal entries in A's book of accounts. The date Mr. B will be the debtor because the sales goods sold on credit. So the entry will be like that in the figure. And the second entry will be the bill receivable as bill accepted by the B. So when at the time of maturity cash received, so the bill will be credited, so the amount will be closed. Same case 1, but entries in the B's book, because B is the purchaser, so he will put the purchase entry in his books of account, and payable, Mr. A is payable to by buying on credit. So the when bill is accepted and drawn, so the Mr. A, the liability will be decreased and bill receivable will be, bill payable will be increased, so the liability will be credited. So when cash paid against the bills payable, so the bill payables is written off. So the third entry will be passed at the maturity date. This is the normal entries. Case 2, the bill is dishonored at maturity date. So the first two transaction will be the normal, as the goods sold on credit and bill drawn. The third will be the different, because the now in case bill is not honored, it is dishonored. So the Mr. B again will be liable to pay. So the debtors will increase. So Mr. B will be the debt debited, and the bill receivable will be credited. So the no worth of bill receivable right now, so it will be credited in the books of A. While in the books of B, it will be like that. Same, the first two transaction will be the same. Purchases debit, Mr. A credit, then Mr. A debit, then bills payables credit. Now no cash has been paid, so it is returned. So the bills payables will be debited, and Mr. A again liability generated, so it will be credited. In case 3, bill is discounted at 5% per annum from the bank. So A's book of accounts will be like that. So the first two transaction will be same. Mr. B debit, sales credit, bill receivable debit, Mr. B credit. So now the bank will be debited, because bank the bill has been present to the bank and discounted. So the bank increase, but bank will charge some amount as a discount. So the calculation is that one, 5%, 15%. So will be like that. Bill receivable will be credited and closed. This will be in the books of A. So in books of B will be the normal, same like before, because there is no effect of bank transaction. So they will pass the entries similarly same. The purchase debit, Mr. A credit, Mr. A debit, bills payables credit, now bills payable debit, and cash credit. Now the bank will pass the entries in the case 3. Bill receivable debit, because bill received for discounting. So on maturity date, the bank will receive the money from the bill's owner. So the Mr. A will be credited, as the amount is given to the Mr. A, and discount is also, because the discount is income for the bank, so it will be credited. So finally, when cash collected from the dry, so cash debit and bill receivable will be credited. Case 4, bill is endorsed to Mr. C in the books of A. It is also not related to the B, so the only A will pass the entries for the endorsement. The first two transactions will be same. Mr. B debit, sales credit, Mr. B receivable debit, Mr. B credit, Mr. C here debit, and bill receivable will be credit. So now bills is with Mr. C, so Mr. C will collect the amount from Mr. B. So there will be no any changes in the books of B. You can see here the same treatment will be like in the case 3 and case 1, case 2. So here the B's book will be like the same. Now case C will be like that. When C receive the bill endorsement, so he will write down bill receivable debit, Mr. A credit, because Mr. A given the bills to Mr. C, so that's why Mr. C will write as a credit. So after when cash received when bill is matured, so cash debit will be cash debit and bill receivable will be credit. So account will be closed for the Mr. C. In case 5, bill sent to bank for the collection. That is also not related to Mr. B, so only A's book account will be written over there. The first two transactions will be same. The third will be like change only. The bank for collection will be debited. Banks for collection. will be debited and bill receivable will be credited. So what happen will be when in case of so it will be if dishonored, then what will be happen? Mr. B will be again debited, bank for collection will be credited. So bank some charges also there. So Mr. B will be debited for noting charges and bank credited. So the bank charges will be debited against for the collection and bank will be credited. This entry will be passed in A's book of account. Case 6 here bill renewal. Here Mr. A sells good to Mr. B for amounting 2000 and draws a bill for 3 months. B accepts the bill and returns to A. B requested to renew the bill with the interest 100 for next 3 months. So the account will be like that. The first two transactions will be same. Mr. B debit, sales credit, B receivable debit, Mr. B credit, and Mr. B is debit while they're cancelling the bill upon the maturity date. So Mr. B will be debit again and bill receivable will be credit. So the bill receivable will be cancelled on. So upon with the interest 100 it will be renewed. Mr. B will be debited for the interest. Interest is income for the A, so interest will be credited. So the bill amount is now 2100 as the interest amount is also including in the bills receivable. So Mr. B will pay at the end of maturity of the bill 2100 including the interest also. This is another this is the case retirement of bill under rebate. So will be like that. First two entry will be same for the bill of exchange. The third entry will be the entry of the retirement. The cash is received by the B, so cash account will be debit. And rebate mean so the discount is given by the Mr. A, so it will be debited. So cash will be received 100 less than the actual, so the bill receivable will be 2000 complete. And then on the case 8th, effect of insolvency. So the first two transactions will be same, the second and third will be changed. So Mr. A received the amount less 500 less, so he will write the cash account 1500 and the rest amount will be debited as the expense of bad debts 500 and the bill receivable will be 2000. So account will be closed accordingly. So the difference will be treated as a bad debts which is not recovered due to the insolvency. Thanks for watching the video. Please like, share, comment and be connected with us for such informative videos.